welcome back to my channel Accounting for the Win. And today we're discussing about a topic that looks simple but it's actually not so simple: statement of cash flows indirect method. So in today's video I'm going to be breaking down a few traps that you must avoid while you're solving MCQs. So let's get right into the video. Now, this is a quick recap. To get to cash flow from operating activities, you have to start with net income, add back non-cash expenses, adjust for gains or losses, and adjust for working capital changes. The first thing I want to highlight is depreciation and amortization. You're supposed to add it back. Sometimes you mess up the signs and you think, oh, depreciation is an expense, so I am reducing it. No, it is a non-cash expense and we do not want it in our cash flow statement. Okay, why am I adding it back? My starting point in cash flow from operating activities is net income, as we discussed in the recap. Okay, it is net income, and under net income we reduce depreciation. Now, to net off that effect of depreciation, we are supposed to add it back. Okay, the second thing is confusing interest and dividends. Now, there are four items here: interest expense, interest income, dividend income, and dividends paid. Now, interest expense and interest income is an operating activity. Okay, dividend income is an operating activity too, but dividends paid is financing activity. Now, this is not something you have to memorize, but if you completely understand what items come under operating, investing, and financing, you would know why dividends paid comes under financing. If not, let me know, I'll make another video about that. Okay, so the third trap is the most important thing ever: working capital confusion. The adjustments for working capital, right? Now, increase in current assets, decrease in current liabilities, add them, subtract them. This is so confusing. How do I memorize it? No, you don't have to memorize it. Let's break it down one by one. Let's go with current assets. Okay, now let's say there is an increase in a current asset. Now, increase in a current asset means I must have bought a current asset. That means I must have paid some money. Okay, so that is a cash outflow. Cash outflows are subtracted. Next thing, decrease in current asset. I must have sold my current asset off. I must have received cash inflow. I'm going to add it. Going with current liabilities, there is an increase in current liability. Okay, I have an increase in payable. That means I must have taken cash from someone. So inflow, add it. There is a decrease in current liability. I have paid back the cash that I owed to them. So reduce it. If you understand this one example, you won't probably misread the question again. So take a look at this. In the previous year, my accounts payable was 75,000. Now in the current year, my accounts payable is 95,000. So what does that mean? There is an increase of 20,000. The increase of 20,000 is an inflow. I have taken more money, inflow of cash. So I am adding it. So increase in current liabilities is supposed to be added. So now you can, whenever you have a confusion, you can just put numbers and think whether cash is coming in or cash is going out, and that's how you solve it. Next point is you might misplace the gain on sale of asset or loss on sale of asset. Let me explain. Generally, when you sell an asset, the whole amount, the whole cash that is received from that sale goes to investing activity. Now, anything that is going in your net income as a gain on sale or loss on sale is supposed to be net off. You're not supposed to include any of that effect in operating activities. So if there is a gain on sale, I am going to subtract it. If there is a loss on sale, I am going to add it back. These four traps, they show up constantly on the CPA and CMA exams, so make sure you note these down, you practice them so that you don't face a hard time in the exam. And if this helped, hit like, subscribe, and drop a comment on how you like the video, and we will meet in the next video. Thank you.